Hello and welcome to the latest edition of BM Talks, where I'm delighted to be joined today by Kallum Pickering of Peel Hunt, Chief Economist. Have I got that right, Callum? How would you like to introduce yourself?
I'm Chief Economist at Peel Hunt, and for about 10 years I've been writing a twice a month column for the Daily Telegraph on economic issues, global as well as UK. And
Yeah,
then I've occasionally written for other places like the Evening Standard and the Spectator and City AM, where you also write.
indeed. Yeah, we all meet over at City AM, all of us, or on Twitter when we're not there.
Right.
Sorry, X. Yeah, I'll
X.
never get around to calling it that. Anyway, thank you so much. We are recording this. I'm going to turn this around as quick as I can because we're only ever a tweet away from another development in the ongoing war, and then of course what that means for the global economy. And Callum, with your background as a trained economist, I know that you are very clear on the macroeconomic implications of all of this, as well as the fallout politically. So let's start with the conflicts in the Middle East. And what is your base case? Sketch out for us how it goes from this moment forward. As we speak, at this moment, there's been closure for what is it? The Strait of Hormuz for 7 weeks. I mean,
Yeah.
it's been prolonged, but there is ongoing optimism that somehow resolution is just around the corner. So, how do you see this playing out?
Well, the optimism, I think, let's start with that, basically comes from a sort of consensus view in markets that it just can't go on. Something that can't go on forever must stop at some point. I know that's a sort of odd way to work from it, but if we just think
Mm,
about the scale of this, about 20% of global oil comes through the Strait of Hormuz, not to mention gas, other refined petroleum products. Then you have all of the chemicals and the gases, the heliums, and all the rest of it that comes through. This is a huge global supply shock. Just oil alone, about half of it is probably fully disrupted, stranded. So you're looking at just in that one essential category, 10% of global oil supplies are disrupted. Um, to kind of give the numbers for your listeners, the world consumes about 100 million barrels of oil per day. Let's say normal circumstances, 20 million goes through. 10 million of that has found its way out somewhere. 10 million is stranded. America consumes 20 million barrels per day. So you're
wow.
looking at half of the daily oil consumption of the US is just stuck there.
Mm,
And one of the sort of oddities of this is if you think about the way the global supply chain works, the ships that leave the strait don't arrive in Europe for sort of 7 to 8 weeks,
mm,
which means when the shock, let's say, started, it's taken such a lag
yeah.
for the for it to become visible. But this is a textbook supply shock. And when we face these kinds of supply shocks, no amount of money can cure us of the shortage. It just has to be accounted for somewhere. And so
Yeah.
the way I think about this is I think about this in three stages. And I think we're now at stage two.
Hmm.
So the first stage is that floating inventory for things like oil and petroleum products, the inventory that businesses have allows us for a period, this 7 week period, let's say, to just smooth this over where it basically shows up in prices. So
Yeah.
prices adjust, but output can be maintained, and we can adjust and we can smooth. And actually, in some respects, we can do some short run efficiency gains. We can use less energy for certain production. We can switch out of one thing and we can do another. But
Mm,
then eventually, once you actually get to the point where you have physical shortages, it's no longer just a question of how much the prices have to rise and adjust. It's how do you account for these shortages? And so for the first, say, 6 weeks of this, you could have said with sort of half a straight face, we don't need to downgrade our growth outlook too much around the world this year. We can just expect a bit more inflation. And
hmm.
then once it's open, we'll get back on track. We're now at the stage where these supply losses have to be accounted for in output with a risk that it gets accounted for in employment. So I wouldn't be surprised if jobs data starts to weaken too, plus this inflationary response. I think we might talk about some of these kind of nerdy aggregate supply, aggregate demand charts when we think
Yes.
about it in UK context later on. Then for me, there's a question of how long this second phase lasts for. The COVID lockdowns were this second phase. The 2022 Russian gas shock got to this second phase. There's then a third phase, which I'm most concerned about. It's not inevitable, but it's something that we need to watch, which is if we don't have the inputs for production, we don't have the outputs that can be sold. If we don't have the outputs that can be sold, we don't have the revenue that generates the profits. And so even perfectly solvent companies that are not selling their wares and making profits suddenly become an unknown credit risk to the system.
Mm.
And the danger is that these output losses transform into profit losses, which then cause credit problems around the world. And so the danger is that this not only becomes an economic problem, but a serious financial one in time. And various central banks around the world and regulators have drawn attention to this. I think there's a separate question, which is, and I'm going to leave it open, is why have markets been so sanguine? Why have markets been
Yeah.
so risk on and so relaxed? But I'm very clear about the way this thing unfolds, and I think we're in this stage two now. We're seeing these output losses become a bit more visible.
Well, actually, this is why it's great to talk to you at this juncture, because there's a real economic impact here that wherever markets want to price themselves, you can't really escape the economic logic. You know, as you said, this is how supply shocks play out. When you look at that stage two to stage three, is there anything we'd be monitoring? Is there anything we can see in the data? Is there a sector or a company or a part of the world or even a currency or something where it might say a sort of red warning signal or a red flag that, you know, as you've said, you've sketched out something where we need to keep an eye on it, you know, which is absolutely what we do here at Blonde Money as well. It's all about what are those risks on the horizon. So that's why I'm asking you if there's anything specific you would be looking at there.
This is a good question. So I would distinguish a bit between what can transmit this problem and where the problem may actually show up. And so
Yeah.
the first thing to point out is, by and large, across the private sector in the advanced world, balance sheets are in fairly good shape. Banks are
Yeah.
well capitalized. Businesses and households have got tons of cash. Debt levels are either low or where they're high, they're manageable, with the exception of private credit. Hit pause and we'll move that
Yeah.
to a second. Then you look at public sector, and it's a completely different scenario. Right? As far as the eye can see, debt levels will rise in advanced countries due to aging populations and a mismatch between tax and spending plans. No government in power or anyone wanting to contest power has a serious plan to tackle these issues. And bond markets have woken up to the fact that in a world of noisy geopolitics and supply shocks, inflation is back. And so
Yeah.
inflation now gets priced into bond yields. Now, for advanced countries that borrow in their own currency, there's very little sovereign credit risk that we should be concerned about. It's exciting to write and talk about all of this stuff, but the US is going to meet every one of those debt liabilities. So is the UK. But whether or not the interest that they have to pay in order to do so is tolerable for parts of the private sector, that's a completely different question. And so the specific problem that I'm concerned about is when you look at AI valuations, which in my view are not, they're not too high. I'm hopeful about this sector and this technology,
Yeah.
but it assumes that these companies can actually make this stuff and sell it, and it's energy intensive and it's commodity intensive, and
Yeah.
that's the part of the global economy which is now being threatened by this war. So their ability to produce to meet these expectations, which are embedded in these high prices, is a challenge. A lot of these transactions and a lot of this part of the market, especially through the private credit, has been leveraged.
Yeah.
And so you have this situation where the discount rate on the liabilities is going up and the outlook for their sales is potentially coming down. And this is always where you get these crunch points. This is where you get these crunch points. So I'm always concerned that at some point the rubber hits the road and suddenly we get a few bad headlines. And then once people are aware that this is a problem, suddenly we look much more carefully at potential pockets and sources of credit risk. And then that's where you get these contagion effects. But I would just go back to my earlier point, which is fundamentally the private sector has much better balance sheet health than at any time probably in the last 20, 25 years. And the last two crises we had, which was Russia 2022 and then COVID, we tested the balance sheet strength of our economies. And actually, in the end, we saw that it was there. And then I suppose there's a second thing here, which is to say that even if policymakers are constrained on the fiscal side, we are not, as we did in 22, subsidizing energy costs quite so much in Europe, and actually we don't yet need to. And central banks couldn't easily cut interest rates to help us out.
Mm.
Still, we have ways through financial policy to plug gaps in the financial system if we need to. And so, if we were to see these air pockets, I wouldn't see these as let's be terrified, we're heading into a massive financial crisis. It's much more, okay, how do central banks plug this up? As we did in the UK with the pension system, or as the Americans did with Silicon Valley Bank, or even as the
Mm.
Europeans had to do with Credit Suisse and
Yeah,
UBS. We have tools outside of taxes and interest rates to deal with these problems, but
yeah.
don't think that they don't exist, is my point. They do exist. It's at what point are the catalysts there to transform them into system shocks?
Brilliant. Love that. Great thing to be focusing on. No, I mean, look, we are in a world of people are crunching the economics, people are
Yep.
analyzing what it means for them, what it means for the country. They're looking at the government's balance sheet, they're looking at, Amazon, they're looking at Alphabet,
Yep.
and actually it's almost too much. So
Yep.
it's good to know, as you say, like how could it potentially get transmitted? And kind of ironic, isn't it, that in many ways, Mag 7, it couldn't have been a more specific shock in terms of highly energy consumptive businesses, and a huge demand. We continue these quarter after quarter, these tech companies are talking about massive demand that they've had for the prior quarter, and then look at Nvidia. It's always
Exactly.
advising there's even more coming down the line, and they were talking about supply shortages even before all of this. So yeah, I think we will there'll be continued focus on that. That's for sure.
I mean,
Um,
I think a very quick point is there's a difference between a structural supply shortage that allows a company with strong demand as far as the eye can see to
mm,
enjoy some pricing power
yeah, yeah, yes.
versus this, oh, tomorrow actually the world's not going to be like it is today,
Yeah.
and we've got this big hole in our production schedule.
Yes, that is a very important distinction.
There's a distinction there, yeah.
That is a very important distinction. Yeah, because companies, deal with forecasting demand,
Exactly.
years and years out,
Yeah.
and that's how they do their production lines and all the rest
Yeah.
of it. This is like absolute classic macro and microeconomics, isn't it? It's
It's great.
which
Well, I have a rule that economists make mistakes more often when they abandon the models than when they stick to them.
yeah,
It's not to say that the models are perfect, but some basic framework
yeah,
actually can be quite
framework.
useful.
Absolutely. And I encourage people to look at Callum's output on that, because he has done, don't panic. They are, I would hope, understandable
Yeah.
graphs and charts to understand things like aggregate demand and aggregate supply. And don't, your eyes shouldn't glaze over at that. It's a good way of thinking about all of this. And we'll come to that. We'll come to that specifically on the UK. Before we leave the outlook for the war, just to touch on the geopolitics of all
Yep.
of this, and this sense of a deal, whatever a deal means between the US and Iran. I mean, what should we be looking at? There is obviously a meeting coming up between President Trump and President Xi, and
Yep.
the China angle. I talk about a US-Iran war. It's clearly also a US as one hegemon versus China on the other side of things. I mean, well, again, let's think about it as a framework for how to think about how this plays out, rather than the tweet here or there. Maybe let's say um, what's an optimistic outlook of a deal, of whatever that means, or what do you think that could look like over the next few weeks, or how might it plan out?
So I think the deal in the end is not going to be far away from what, and the process to getting to a deal won't be far away from what markets had originally assumed, which is that
Mm,
um, the Americans, the Trump administration, can't wear a costly inflationary war
yeah.
for very long into an economy which looks like it's slowing, and with the midterms in November coming up.
Mm,
So um, and but for a host of reasons, but I think there's a very simplified model to think about the US, which is that it runs high deficits, fiscal deficits, it draws money in from the world, That helps push up the stock market. Because the stock market's up, companies invest, households spend every dollar they earn. That produces the growth, and the world feels good about the US deficit not being a problem. That's basically the way that the US economy has been running for the past few years, with nuances. So forgive me if any American economists are listening to me and say that's an oversimplification, but it's not far off. And if you look at structural imbalances, you see these appear pretty clearly. And so if you start fundamentally threatening either the growth or the deficit or the stock market, then you have a problem and the US economy could roll over. And at some point, it will have a cyclical slowdown. You don't want that in the midterm year. So the US has the incentive to eventually end this. Then from Iran's side, Iran, of course, needs to create some deterrent so that this doesn't happen again.
Mm.
And it's found a cheap way to do this through the Strait of Hormuz. But then at the same time, in the background, the market's assumption was, well, the Chinese eventually would put pressure on Iran. Beijing would put pressure on Iran to come to terms with the US. And you would get these basically the Americans and the Chinese coming together via negotiations and say, right, let's get the deal. It's going to be a Trump deal, which means it's going to be vague. A lot of the stuff that will be so-called wins will have basically been the kind of ex-ante status quo. Okay, fine. But I think the strait will be open. And then I think there'll be some structural implications where the various producers in the region start to reroute. And I think that's basically the base case. What I think is important here is to note that the rivalry between the US and China
Mm.
is the big story of our age.
Mm.
And yet, for its part, China is fairly quiet in all of this. But
Yeah.
any risk to global economic growth for China, which is the world's biggest producer and world's biggest exporter, is its number one concern. So the idea that it's not self-interested in the way this plays out, or that it's somehow passive and it's allowing the Iranians and the Americans to sort of sort it out themselves, I don't see this. And so
Mm.
I think there are a couple of points here which are important to note. The first is, look at how China has behaved every time the US has got tied up in some Middle East issues of significance. So in the 1990s, the first Gulf War with Bush, that's when China accelerated its market reforms. It
Mm.
moved from command control to market, and its economy accelerated. That was a pivotal moment. Then through the 2000s, when you have the second Gulf War, you see the Chinese entering World Trade Organization and committing to being a major producer. By 2010, it overtakes America as the world's biggest producer. So
Yeah.
it's more market oriented in
Yeah.
key areas, and then it's the biggest producer. What's a third ambition? China wants the renminbi to be a reserve currency.
Yeah.
That's one. It also wants to secure its supply chains. And what's striking about this Middle East situation is one of the big marginal buyers of the dollar, which allows the US to run these sustained deficits and run this leveraged economy,
Mm.
are the petrodollars that come out of the Middle East.
Yeah.
And so anything you can do to challenge this from China's point of view is in its longer term advantage. And you'll remember like 5 or 6 weeks ago, there was a few days of speculation where perhaps Iran would let ships pass if they paid in yuan. I
Yeah.
thought
Yeah.
that was really interesting. It was one of those things where, oh, why aren't people paying more attention to this? And the thing about capital flows and reserve currencies, when you study economics, you focus a lot on this. But when you're actually an economist, you don't have to pay much attention to it because it's just like the dollar's the reserve currency. This is the way the world works.
Yeah.
You sort of forget. But then every now and again, the world changes and the
Yeah.
system gets reorganized, be it the Nixon taking the Americans off the gold standard in the early 70s, Bretton Woods in the 40s. You can go back and you can see these periods. And so we're due some change. And so I wonder if there are some strategic opportunities which China is seeking, which are not yet clear, but we'll see when we look backwards. And you mentioned the point around the Trump summit with Xi of course, in Beijing. This has been cancelled once,
Yeah.
delayed at
Mm.
Trump's request. I wonder to what extent, and I leave this as a kind of an open speculation, Xi and China see it in their interest to let Trump arrive for the meet with Xi without a deal,
Yeah.
right?
Yeah.
Just so that Trump is a bit compromised when he's sat in the room with Xi. I wonder if they see some strategic advantage in this. And so if I had to guess, I would say China does want a deal because it wants to end the economic
Mm.
shock. But it has some strategic advantages in letting this thing play out. And it may be helpful for various reasons to let Trump arrive in Beijing without the deal. And so I wonder if through the back channels they're just slightly saying to the Iranians, "Yep, we'll put some pressure, but not yet. Let him come to visit us without his deal."
Well, absolutely a point of, geopolitical calculation
Yeah,
is driving the economics, as you say. And sometimes that does get lost. I totally take on board your point about the yuan. I mean, I think that, the dollar is still this supremely dominant global
that's right.
currency.
Yeah,
Dollars are used absolutely everywhere, but incrementally over the last decade or so, maybe more, there has been these uh, attempts by China and successful, swap
exactly.
lines in yuan and payments
That's
in
right.
yuan and setting up their alternative to SWIFT. And we
Exactly.
saw, obviously, with the
Yeah.
Ukraine war, that one of the most shocking things that occurred, amongst many, many shocking things, but from like a geopolitical perspective, was the freezing of Russia's foreign exchange reserves,
Yeah.
which really signaled to uh, certain countries, if you fear the West broadly, let's put it in a box, but the West may one day retaliate or attack you, then you want to have an alternative system. And there is this alternative to SWIFT, the payment system that's
Exactly.
being created. And it sounds like one of these really niche, geeky, not very interesting things. But as you pointed out, it's the foundation of economics, really, is
That's
flows,
exactly. Yeah.
trade balances, currencies.
It's the water around us that we don't notice.
Exactly,
Yeah.
exactly.
It,
So
it's and I would just say the world won't reset to the way it was before, say, Trump 2017. And so I'd just encourage certainly economists to just look at history and certainly study the period when um, the American the Americans came off the gold standard and Nixon had his agreements with the Saudis to price their oil in dollars. And it's meant that these surpluses from the Middle East oil producers have been recycled back into the US, and America has various structural sources of marginal demand for the dollar.
mm,
And when you get these geopolitical issues emerging, China just in small ways tries to unpick this, and you've highlighted some good ones there. And I think, let's be clear, the yuan is far away from being a reserve
yeah,
currency. Having
yeah,
closed capital markets is a huge barrier
yes,
to that.
exactly.
Um, but just to invite the idea into people's minds that there is an alternative to the dollar when you sell your wares on the global market, this is how this starts. And so I think, you know, there's um, there's a big power play, and history is going to capture this. We won't realize it in real time, but we'll see there are just significant moments when, oh, that's when the nature of the world changed. And I don't make a prediction which way it's going to go, but I think the Middle East situation we see now is potentially one of those catalysts.
Yeah, one of those flashpoints, definitely. Well, we love a bit of economic history on this podcast. And I remember, when COVID began, it was like, well, hang on a minute, we don't really have any other data. We can't go back to 1918. There wasn't as much data to compare, when you have the Spanish flu to try and compare it with this.
Yeah,
Not to mention the fact that, the structure of the global economy is entirely different. So there's this amazing thing, yeah, history doesn't repeat, it rhymes. And in financial markets, we love to try and look for patterns, and they do exist. But it's not a petri dish where you can repeat the exact same experiment, millions of times over. Because actually, there are sort of similarities, but there are massive differences as well. So yeah,
that's exactly right. And actually, just on the dollar,
mm,
we're broadly
yeah,
discussing de-dollarization here, but there's an important distinction to make between the usage of dollars and the value of the dollar versus other currencies.
yes, go
And I
on.
think that this is quite often a bit mixed up. So the dollar periodically goes through these long periods of depreciation, long periods of appreciation, which can be explained by factors completely unrelated than the global demand for using dollars. And so the normal way to think about things is currencies are just prices. They reflect demand and supply like any other price. And if you trace this post-gold standard period for the dollar, what you see is an appreciation up to the middle of the 80s, then about a 60% depreciation into the early 90s. Then from the early 90s up to 2001, a big appreciation again, then about a 50% depreciation from 2001 to 2009. 2009 to late 2024, another big appreciation. And we've had about an 11% depreciation since early 25. And this is trade weighted dollars against all of the
Yeah.
currencies. Why do I go through those cycles? Well, if you then look at US stock market performance versus the rest of the world, when the dollar is appreciating, the US market outperforms. When it's depreciating, the rest of the world outperforms. The US market, which is still going up, but it still outperforms. And up until the war,
Hmm.
the Iran war, just so we're clear which one we're talking about, January 2025 until February 2026, the US dollar had depreciated by about 11%, and the rest of the world had outperformed the US
Hmm.
equities for the first time since pre-global financial crisis. And what's happening is this dollar and markets, equity markets trend is reflecting technological cycles. Again, we can go back
Yeah.
to an economic model. America invents something,
Hmm.
the capital market does its job and puts money into America. That pushes up the dollar. It pushes up US stock markets. Once those companies with those high valuations sell that stuff around the world, the technology diffuses. We then outperform because we get the productivity. The capital market does its job and supplies us with the money so that we can invest. And then the process repeats again. Currently, it's tech. In the 90s, it was the internet and the personal computer. And then before that, there was some other stuff.
Love that. That's great. Very, very good. Tying in the technological revolution theme, which is so
Yeah.
important. And actually, as well, super important for long-term investors, of which there are very many. Often headlines are dedicated to what happened in the last hour. And really, at the end of the day, when you look at pension investments and most people's timeline, let's hope it isn't 15 minutes because that might not be the most stable way. It's exciting, but it might not be the most stable way to consider.
It's just to say, if we were to abstract from the Middle East and abstract from any rivalry playing out between China and the US, on this basis alone, one would still anticipate the dollar to be in structural depreciation and non-US markets to outperform just because we're absorbing this technology. This would be a
Yeah.
5 or 6 year trend. And I was hearing this from US investors last year that had seen this play out twice before.
Yeah, yeah, absolutely spot on, indeed. Yeah, so yeah, I was just thinking about the way that is then grabbed by, frankly, sort of it becomes a weapon almost politically because
Yep.
and that's of course why de-dollarization as a theme seems to have grabbed everybody's perspective.
Yep.
Okay, right, we've done loads on the whole world, and I wanted to talk to you about the UK, so we'll have to focus on
Yes.
that for our last third of our discussion. So yeah, so coming to the UK, you've sketched out the economics, the outlook. Specifically on the Bank of England then,
Yep.
what do you see happening? Obviously, there's been this big flip from expectations of cuts to hikes.
Yep.
Um, how does that play out? What's going to happen to the UK economy? And then we'll come to the fiscal and political side. But let's just look at Bank of England first.
Okay, a few guesses. I think the Bank of England won't hike this year. I
Mm,
suspect they'll still actually manage to cut in Q4. That hinges on my, let's say, assumption that the war will be over and the strait will open. But my problem at the moment with the Bank of England is the way that it hasn't properly straightened out its communications
mm,
to explain the differences between this war and 2022 and how the shocks are different. But just to finish off my base case before we get to that, I suspect we're going to see inflation pick up again over summer, probably peaking at a little bit less than 4%. I think we'll see virtually no growth through summer, but then by Q4, because demand is weak in the UK and we have some spare capacity in various parts of the economy, you'll see those inflationary pressures quickly give way to disinflationary pressures through Q4, and we'll probably be seeing or expecting by then inflation to slightly undershoot in 2027, and growth to then re-accelerate to something like normal, which will be probably around 1.5%. And so I'm sort of sub 2% inflation, though thereabouts 2% next year and 1.5% growth. With this year, unfortunately, the same sort of amount of nominal, but more inflation and less real. From the Bank of England's perspective, here's an interesting point. In February 2022, in
Mm.
its meeting, in its minutes, in its monetary policy report, this is, by the way, 3 weeks before the Russian invasion of Ukraine.
Yeah.
There's no mention of the invasion, although there is some vague mention of geopolitical uncertainty pushing up gas prices. But in that report, it had already projected that inflation would reach 7% in
Mm.
2022,
Wow.
having revised it up 3 times. And that was the combination of
Mm.
dislocations coming out of COVID plus strong demand.
Yeah.
Why did we have strong demand? Because monetary policy was much too easy through 2021,
Yeah.
because government ran too easy fiscal policy.
Yeah.
And so when you think about the Russia effect, and again, I'm sorry for going into so many numbers, but
No, it's important.
we peaked at nearly 600 pence a therm on
Yeah.
gas.
Mm.
And that was even before. And before that, the Bank of England had said inflation is going to hit 7%.
Mm.
Inflation hit 11%. And so the Russia effect was not the difference between the 11% and the 2% target, so 9 percentage points.
Yeah.
It was the difference between the Bank of England's forecast of 7 and
Yeah.
the 11,
Yeah.
which was
Yeah.
4 percentage points. And that's assuming, by the way, the bank had perfect foresight
Yeah.
and wouldn't have had to revise its forecast up even more as it had done in previous quarters. So the Russia effect was basically 4 percentage points of additional inflation, with gas at 600 pence a therm. Today,
Mm-hmm.
gas is at 100 pence a therm.
Mm. Yeah. Yes.
And we had annualized inflation at 2% before this.
Mm.
Annualized, not annualized. And so I don't see this scenario where we get to big inflation numbers unless things go very badly wrong, which so far, so good. The Bank of England, unfortunately, found it very convenient in 2022 to blame all of the inflation on Russia and the invasion of Ukraine and the gas shortage, and
Mm.
not its too easy monetary policy.
Yeah.
The result was the muscle memory in markets meant as soon as we had the gas and oil worries this year, the market said, oh, this is going to be another inflationary crisis.
Yeah.
And it won't be. And this is again where let's go back to this model. You mentioned the aggregate demand, aggregate supply. And
Yeah.
so since you asked, I'm going to use it. The
Please
way to
do.
think about Russia was we pushed demand up as we contracted supply.
Mm.
And so the net effect was the price level jumped a huge amount, but offsetting what would have been output losses because of lesser supply, we boosted demand.
Mm.
And so everyone had pricing power.
Yeah.
We had wages growing at 9% year over year. We had nominal GDP growth annualizing 15% along with consumer spending. We would just come off the back of a big surge in employment demand because we
Mm.
couldn't get the capital goods through COVID. And so this economy that was already overheating and had demand racing ahead suddenly didn't have the supply.
Yeah.
This time around, demand is much weaker. The
Yeah.
unemployment rate is rising, vacancies are coming down. Nominal measures of demand, so the broadest measure of aggregate demand, nominal GDP, is growing at less than 5% annualized.
Mm.
Consumer spending is less than 5%. Private wages are 3%.
Yeah. Big
You're
difference.
not you're not pushing demand out as you're contracting supply, which
Yeah.
means the distribution of risks is much more skewed towards output losses and
Yeah.
employment losses and a bit of inflation versus all of that inflation and no output losses in 22. And again, just remind yourself, we all thought we would get the recession in 2022, which we didn't get.
Yeah.
And it's
Yeah.
because demand was so strong, businesses had the pricing power. And so I fear that the Bank of England has set expectations by its convenient use of this Russian invasion explanation for inflation. And it set expectations for inflation and rate hikes that should not play out. So I hope the Bank of England resists rate hikes.
Can I just ask about in that latest Bank of England meeting, they had these three scenarios
Yes.
that they had, and so do you think that those scenarios were not well communicated or not well formulated, or because look, there's obviously the Bernanke review has led to these scenarios. There were all this criticism that they haven't communicated well. So it sounds like they're still not quite hitting the spot from what you're saying.
So there was a lot of good stuff in the Bernanke review. The minutes got shorter. The statement was a bit clearer. I have mixed feelings about these individual policymakers' paragraphs,
Yeah,
actually, but they've made progress.
yeah,
I My issue with these scenarios was that they were all skewed towards the shock showing up as more inflation.
yeah,
There's no scenario where the Bank of England projects a recession,
yeah.
where the supply losses produce output drops, and then we undershoot inflation heading into next year, which I think is a conceivable scenario in a
Mm,
protracted war. So the base case, which is slower growth, a bit of inflation, and then things normalize into next year, should not have had basically the same profile for output, but more inflation in the alternative scenarios, which skews markets to think the Bank of England is either going to keep rates on hold or really go for
yeah,
it by raising
yeah.
interest rates. There should have been an alternative scenario where they just signal to markets that this might show up as output losses with much less inflation. And in that scenario, we would really be resisting interest rate hikes. But there's a second point for me, which is just an issue with the bank, which is that I just don't like the way the Bank of England produces its forecast by using the money market rate.
Oh,
I think this is really, really bad. And the reason is there's a sort of, dare I say it, there's this sort of incestuous relationship between the market and the bank, where the bank is trying to signal to the market what it wants to do through its forecast, but the market is trying to use the forecast to guess what the Bank of England will do. All at the same time, in the central forecast, the Bank of England wants to convince markets that it thinks it can always get inflation back to 2%. So that's where the forecast ends up. And so you basically always validate market expectations
mm,
with your central forecast. What's the alternative? The alternative for me would be, and despite my best efforts, I've never quite convinced anyone at the bank that this is the way they should do it, just forecast based on no change in bank rate
right.
and allow inflation to go up or down wildly if you like. Because you can say, we're not just going to hold bank rate, we're going to have to do something. But think about what that then allows the governor of the Bank of England to do when, for instance, he sits in front of the Treasury Select Committee. At present, we're in a world of repeated shocks, and he is benchmarked against perfect foresight with a monetary policy which gets inflation back to 2%, which is impossible.
Mm.
Right? He's always going to be offside relative to this target. And so he's compared against, well, this is what you said when the shock would happen. You'd be at 2% now, but you're at 3%. You failed against your target. And so it erodes the bank's credibility as we go through these shocks. Imagine if the bank just allowed inflation to float up or sink with no change in rates. Then the bank actually changes rates and gets inflation back to 2%. Bailey could say to the Treasury Select Committee, look, we've raised rates 3 times. Yes, inflation's 3%, but it would have been 4.5 had we not done anything with rates.
I
And
see. Yes,
you
I
say,
see. So the doing nothing then gives them space to be judged on their actions
correct.
more
That's
fairly, more fairly.
But that's how medicine works, right? My hay fever is kicking in now. It's a sign that summer is coming. I'm thrilled about it. But I don't measure the quality of my antihistamine against someone who doesn't have hay fever. I measure it against how I feel when I don't take my medicine.
Yeah,
That's the thing that tells me it works. And so the Bank of England has the scientific experiment of monetary policy wrong. Its benchmark should be what if we didn't do anything? Not what if we got it perfectly right, because that is not possible. And so I wanted the review to produce a framework which accepted that the world was unpredictable, it was uncertain, but it would make the Bank of England's communications and its policy decisions robust and credible, giving the reality of life, not given this more kind of uh, the economist model where everything's perfect and sanitary and all the rest of it. That world doesn't exist. So we shouldn't try to set policy
It'll
in
be
that world.
interesting with and Kevin Walsh at the Fed, seeming very skeptical about forward guidance. There's been quite a
Yeah.
long period of central bankers enjoying a forward guidance and enjoying that almost Faustian pact you've described with financial markets, where
Yes.
they're very intertwined, but it all becomes a bit endogenous then. And and causes its own risks. You know that it
That's right.
sounds good, but it straws other things. We should do a podcast, by the way. I just realized we do a podcast just on that because
Oh yeah,
it's interesting.
we could nerd out on that. I
We could
definitely.
totally on that.
Yeah.
But we only have a few minutes left, and I want to get you to, because we've talked about Bank of England. I want to get you to gilt,
Yep.
and clearly in the outlook you've been describing globally, there is an inflationary shock of some description working its way through the system. We'll see
Yep.
how long that persists, how large it becomes. There's a repricing of bond yields globally. There's no doubt gilts are high beta all the time. You know, they rally more when it rallies, they sell off more when fixed income sells off. There is a political dimension. We don't need to go into that just at this exact moment, but where do you see fears of UK fiscal sustainability? Does it exist, or is that a very unlikely outcome? How worried are you, I suppose, about this persistent rise in gilt yields?
Um, so we've been an outlier in this regard twice before, in the three times actually, in the late 70s, in the early 90s, and then after the global financial crisis. At each point, the government of the day introduced some device to rediscipline market expectations towards sound money, and it worked, and then the UK economy recovered. Um, the UK is not a debt or deficit outlier
Right,
in the G7 context, and yet we face the highest bond yields. We're an inflation outlier.
right.
Bond markets, I'm convinced, care much more about inflation than they do fiscal arithmetic, which is anathema to the way that the government and the Treasury think about fiscal policy. But take Japan. Japan was increasing its debt to GDP with every single year, and yet the market was happy to charge it virtually nothing while ever it was in this disinflationary cycle. In the last few years, growth has returned, debt to GDP has actually declined, and Japanese bond yields have risen because inflation has returned. We're
Yeah,
pricing in inflation here. We're not pricing in the likelihood that a government will default or something extreme like that. And so the UK has been an inflationary economy over the last 10 years, much more so than any other country and in the G7. And this reflects policy choices. Like in the same way that, you know, we're all obsessed these days about inflammation. You've got to get your inflammation down. Like that's the new health trend.
oh yeah, yeah,
But it's about making choices to get your inflammation down,
yeah,
right? That's the same with policy.
yeah.
Bad policy choices create inflation. They reflect bad choices. This is the price you pay for bad policy choices. So there's a fiscal element, there's a regulatory element to this. Um, Let me give you a number, 3.5%. That's what I think the 10-year gilt yield should and would be if we had had inflation under control. And that's normal economic growth, 1.5%,
Mm,
plus the bank's inflation target.
mm,
That arithmetic, that rule works for the US, where we were at 4% at the beginning of the year, normal growth is 2. And the 3% rate we see on the Eurobond,
mm,
ECB thinks that European growth is around the Eurozone growth is around 1%. So we are offside at the moment to the
mm,
tune of what are we today? 4.9
yeah,
versus 3.5. 140 basis points is a huge amount of crowding out in housing, in investment, in cyclical industries. That's exactly where the
mm,
economy is weak. And so my sense is on a 6 month basis, we're parking the politics, but as long as we are not pursuing inflationary policies 6 months from now and assuming that the war is over, the market is going to reset back to where we were at the beginning of the year, which is to bet that inflation is coming down. And on that basis, yields will fall. We were at
mm,
4.2 at the beginning of the year. I honestly would not be surprised if the 10-year rate were at 4% by the end of the year. And with that, you would see a significant improvement in expectations for growth. And of course, in that scenario, the Bank of England hasn't raised interest rates twice.
yeah, yeah. So to conclude, because we are running out of time, but if you're going to throw it in there, and what a time to mention the politics. You know, people are literally voting as we speak.
Yeah.
Um, so let us assume, however, that there were a government or there were government policy that did move in a more inflationary direction, then
Yep.
your benign scenario would not play out. But is there a point at which there's spiraling concerns about that? That if there were, if there were a leader that had said, for example, about not being in hock to the bond market,
Yeah.
you know, yeah, how do you think gilt markets would take, let's say, a lurch to the left in the direction of the British government?
Badly is the short answer. What I would say is I'm not convinced that this is the thing that's playing out in markets right now,
Yeah,
because wherever we've seen politics, British politics show up in gilt specifically, it's
yeah,
often coincided with weakness in sterling. And sterling has
yes,
held up nicely,
yeah,
actually.
absolutely. Haven't seen
We're,
that at all.
yeah, I think we're slightly at risk here because it's partly just fun to do so. Crowbarring a domestic political explanation for something that's happening. You're right, the UK is an outlier in terms of the size of the moves, and that maybe have a political cause. Um, I'm more confident that the bond market will be a check and balance against a lurch towards anti-growth, anti-inflationary policies than I am that Labour may try,
Mm,
and that, of course, is the risk. Um, I think that betting markets put too high a probability on Mr. Starmer being out by the end of the year. I think he's got more staying power than people think. If he wants to stay, and the bond market with this kind of noise around the Middle East and inflation rate is just reminding the Labour Party that there are some risks if you make the wrong decision. I think that buys him time. Uh, we have the local elections today. It's probably going to be bad for Labour. And it's going to be noisy for a few weeks, and there'll be some pressure on Starmer. I think if there's a change in the short run, if the party try to change him, I think you're probably looking at someone like Miliband
mm,
as the likely candidate. If over summer it plays out, it's probably Andy Burnham as the likely candidate. These are not bets. I'm just reflecting kind of betting markets here. I
mm,
think either of those two would look for someone as chancellor that the market would like. And I think that would include someone like Wes Streeting or even Yvette Cooper.
yeah.
Um, my guess is that Angela Rayner will probably end up as deputy prime minister in any kind of future government where there's a change. But again, my quiet base case is that Starmer and Reeves actually survive this. One thing I would just say as a closing point, I'm not convinced that these local elections, which will likely produce a swing towards the Greens and reform, will give a strong indication of voting patterns at the next general election.
Mm.
Because if both the Greens and Reform get councils and don't do a good job at running them, that will put voters off at the next general election. And that is sort of what's happened in the last 12 months, where we had the local elections last year in May. At that point, Reform were 30% in the polls. They won 30% of the popular vote. They then peaked at 32 2 months later, and all the stuff around the difficulties running councils came out. And now they're 24, 25 in the polls, and they're coming down. The Greens, of course, have just had a big run up in the polls. And so I think voters will see how they do in the local elections, excuse me, at running local government. And if it's not to their satisfaction, I think that that will then be quickly revealed in the polling numbers.
Well, we'll have to leave it with that on that cliffhanger. Although, because I could respond and then we'd have another hour of talking.
Sorry, yeah.
No, it's brilliant stuff. What a gallop we've done around the outlook for the global economy, the UK, gilt markets, President Xi and Trump. I mean, hopefully this is
Petrodollar,
what's that?
the petrodollar.
Oh, the petrodollar. Well,
Yeah.
you can't talk about the world without talking about petrodollar these days. Look, as ever, I would say to everybody, any thoughts, any feedback, please do get in touch with me, helen@blondemoney.co.uk. I'm also on Twitter, LinkedIn, etc. Callum is also often on social media, unusually actually for sell-side economists and research people. Callum, you are allowed to speak and interact, which is useful, I believe,
Yeah.
and I think you enjoy.
I'll let the public be the judge of whether that's a good idea or a bad idea.
Yeah, exactly. We're inviting the trolls now. Oh dear. Anyway, Callum, thank you so much. It's been wonderful to talk to you.
My pleasure. Thank you.
Thank you.